Daniel.
But I'm Mira.
Usually when we look at the financial markets, there's this fundamental expectation of cause and effect. It's supposed to operate a bit like physics, right? Like if the Federal Reserve tightens the monetary screws and labor data comes in hot, borrowing costs go up.
Right, yeah.
And the equity markets are, they're supposed to come back down to earth.
That is the traditional textbook expectation, certainly. I mean, you expect valuations to compress under the weight of higher rates.
Exactly. But then you step into the market we're navigating right now, and suddenly that gravity just, it doesn't seem to apply at all.
No, it really doesn't.
If you're looking at your portfolio today, wondering why things are moving the way they are, we are looking at a tape that is completely dominated by this relentless AI-driven euphoria. And it is entirely brushing off some seriously hawkish Federal Reserve warnings and honestly some very sticky inflation data.
It's the absolute definition of a market operating on two completely different planes of reality. And trying to reconcile those two planes is exactly what we're going to do today.
Yeah, let's quickly look at the closing numbers for Tuesday, June 2, 2026, just to show you what we mean. Major U.S. equities recovered from an early morning dip to end near their session highs. The S&P 500 closed at 7,609.78, and the cash Nasdaq finished at a staggering 27,093.90. The market just absolutely refused to stay down.
Which sets us up for a really critical analysis today.
Definitely. So here's what we're going to do. We have three main sessions. First, what set the stage before the U.S. session opened, looking at European inflation and some wild geopolitical oil swings.
Right.
Then we'll transition into what actually moved the markets during U.S. trading hours, specifically the massive tug-of-war between the Fed and the physical reality of AI. Finally, we'll hit the corporate events recap, looking at a major divergence between Alphabet and Nvidia, and outline what you need to watch next.
And just a quick note before we jump into the deep end here. This deep dive is for market context and discussion only. It is not personal investment advice or a recommendation to buy or sell any assets.
Absolutely. All right, let's get into it. Session 1, what set the stage before the U.S. session? Because, well, the morning started with some real heat over in Europe.
It really did. At 5 a.m. Eastern Time, the Eurozone flash CPI data dropped. For those keeping track, the flash CPI is the preliminary estimate of inflation, right? So it gives the market its earliest look at the data.
Right, the early warning system.
Exactly. And it came in hotter than expected. We saw headline inflation rise to 3.2% year over year, and core inflation hit 2.5%.
Wow. And it wasn't just the numbers, was it? You had ECB official Olli Rehn explicitly signaling that while the European Central Bank might move rates in June, it would strictly be, and I'm quoting here, insurance hike.
Yeah, the phrasing is incredibly telling. I mean, calling it an insurance hike is basically central bank code for, we are terrified of inflation rebounding, but we feel compelled to do something defensive.
Right.
It essentially broadcasts that they're trying to cap the upside risk of inflation without aggressively stalling their economy.
Wait, let me stop you right there. Because if we look at this persistent global inflation narrative, which is flashing red everywhere right now, it just doesn't make sense how calm the bond market is.
Oh, the disconnect is wild.
Right. We just got that stagflationary U.S. ISM manufacturing prices paid print from the prior session. It surged to 82.1. The ISM prices paid index measures what companies are actually paying for raw materials.
Yeah.
And an 82.1 is incredibly high. You pair that with hot European inflation, and you'd expect bond vigilantes to just panic and drive yields through the roof.
You really would.
But U.S. yield didn't spike.
I agree. It looks totally contradictory on the surface, but the 10-year Treasury yield actually fell slightly to 4.455%. The bond market is looking at all this data and essentially calling the central bank's bluff. They're pricing in the idea that central bank credibility acts as a sufficient inflation anchor over the long term, even if rates can't be cut anytime soon, just relying on central bank credibility as an inflation anchor.
So the bond guys were calm. But if we pivot over to the commodities floor, the oil market was throwing an absolute temper tantrum. WTI crude dipped down to $90.65 early in the European morning and then just violently recovered, shooting back up to $93.41.
Yeah, that volatility is a direct carryover narrative from yesterday. We are watching these incredibly tense, ongoing negotiations involving U.S. Secretary of State Marco Rubio, Donald Trump, and Iran over reopening the Strait of Hormuz.
And I want to push back on how the broader financial media is interpreting this.
Oh, please do.
You watch the news, and they tend to treat these geopolitical events like unpredictable natural disasters, like a hurricane that just randomly strikes the energy sector. But we've talked about this before. If you look at it through the lens of geopolitical brinkmanship as game theory leverage, the volatility actually makes perfect sense.
Right, because neither the U.S. nor Iran actually wants a total catastrophic collapse of the global energy market. They both understand the baseline physics of the situation.
Exactly. They're just maximizing their negotiating friction to extract the best possible deal. Rubio's demanding Iran publicly announce the strait is open and commit to nuclear talks. Iran, in response, is halting back-channel messages to protest U.S. involvement in Lebanon.
It's a high-stakes poker game.
It really is. The oil market isn't trading an actual blockage, it's trading the daily swings in leverage.
Which is a perfect segue into a completely different kind of leverage. While the macro and geopolitical tension was bubbling, the pre-market corporate news was operating in a totally different universe. At 8:36 a.m. Eastern Time, a headline dropped that SpaceX is actively pushing Wall Street banks for a record $1.75 trillion IPO valuation.
Trillion, with a T.
With a T. But here is the structural detail that really matters. They are negotiating to pay less than 0.75% in IPO fees to the underwriting banks.
Okay, for our listeners who might not follow investment banking fees, that is just, it's unheard of.
Totally unprecedented.
Wall Street banks take on massive underwriting risk when they bring a company public, and they usually demand a massive cut, sometimes anywhere from 2 to 7% for a deal that size.
Right. And it perfectly illustrates the immense pricing power that highly anticipated tech unicorns currently hold over the financial system. When you have a $1.75 trillion liquidity event dangling in front of them, the banks will take a massive haircut just to be part of the deal.
Yeah.
It shows how much capital is desperately waiting on the sidelines to get into these structural tech monopolies.
Okay, so that was our pre-market setup. We had European inflation fears being neutralized by a surprisingly resilient treasury market. We had oil swinging wildly on game theory leverage, and we had SpaceX flexing unprecedented pricing power over Wall Street. That brings us to the end of our first session. We'll take a short break and then dive right into the U.S. trading day.
That's good.
All right, we are back. Moving on to session 2. What moved markets during U.S. trading hours? Because frankly, Mira, the U.S. data dump should have absolutely tanked the equity markets today.
It really should have. Let's trace the timeline here. At 8:30 a.m. Eastern Time, the Fed's hammock delivered a stark, hawkish warning. He explicitly stated it's reasonable to keep rates steady because of the growing risk of persistent inflation pressures.
And if that verbal warning wasn't enough, an hour and a half later, at 10 a.m. Eastern Time, the U.S. JOLTS report hits. The JOLTS report tracks job openings, and it is a massive indicator of labor demand. April job openings surged unexpectedly to 7.618 million.
Which, I mean, that was way above the 6.8 million forecast. Let's unpack why that number is so dangerous for a market hoping for rate cuts. When you have 7.6 million open jobs, it means employers are still fiercely competing for workers.
And what happens then?
That competition drives up wages, and higher wages feed directly into that sticky inflation narrative Hammock was just warning about. What's fascinating here is how the market reacted, or rather, it didn't react.
Right, because this goes back to what I was saying at the top of the show about financial gravity. We know that discount rates act as financial gravity. When labor data comes in hot, the Fed can't cut rates. When rates stay high, it pulls down the present value of future cash flows, which mathematically should compress the multiples on big tech stocks.
But the market looked at that gravity today and completely shrugged it off. I mean, the Nasdaq dipped for maybe a minute and then just resumed its march upward.
So why did the Nasdaq keep climbing? How does the market just ignore the Fed?
Because the physical reality of what is happening in the tech sector right now is entirely overriding macroeconomic theory. We had two massive midday catalysts that proved it. First, at 11:36 a.m. Eastern Time, the White House signed an executive order on advanced AI innovation and security.
Now, normally, if you tell a tech investor that the president just signed an executive order focused on regulation, they panic. Regulatory overhead usually kills innovation margins.
True. But this order did the opposite. Instead of sparking fear, it established a voluntary federal framework for pre-release reviews of frontier AI models, so the most advanced boundary-pushing models being developed. It provided the structural, regulatory clarity that hyperscalers desperately need.
And hyperscalers being the massive data center operators.
Yeah.
Your Amazons, your Microsofts, your Googles.
Yeah.
They need to know the rules of the road before they sink another $100 billion into concrete and silicon.
Exactly. And we saw what that physical infrastructure looks like just a little over an hour later. At 12:57 p.m. Eastern Time, during the Microsoft Build Conference live stream, which was arguably the major catalyst of the entire day.
Okay, let's unpack this. Microsoft CEO Satya Nadella is on stage, and he brings Nvidia CEO Jensen Huang onto the live stream. They announced this deep, unified hardware integration for agentic AI devices. They unveiled Project Solara, and Nadella confirmed that Microsoft has deployed the largest volume of NVIDIA's new Blackwell chips specifically to power these autonomous software agents.
Let's clarify what agentic AI actually means for the listener, because we aren't just talking about chat interfaces anymore.
No, not at all. A chatbot waits for you to type a prompt, and then it replies. An autonomous software agent is given a goal, and it executes it across multiple platforms without your input. It reads your calendar, negotiates a time with another company's AI, books the flight, and files the expense report, all in the background.
And to run millions of those agents simultaneously requires an unimaginable amount of compute power. What Microsoft and Nvidia announced today isn't theoretical software. They are laying the heavy iron physical train tracks for a completely new industrial revolution. It confirms our thesis that AI CapEx is a cycle-agnostic arms race.
Meaning they truly do not care what the Federal Reserve is doing with interest rates. They don't care that the JOLTS data was hot. These companies are in an existential sprint to build this infrastructure, and they're spending hundreds of billions of dollars to do it, completely immune to the macroeconomic headwinds.
Absolutely. So to wrap up session 2, markets are explicitly rewarding physical AI deployment over macroeconomic fears. The AI reality simply overpowered the Fed today. We'll take another quick break here before we dive into the corporate specifics.
Perfect. All right, we're back for session 3. Corporate events recap and what to watch next. Because if you want to see just how expensive this cycle-agnostic arms race is, you just have to look at the massive corporate catalysts that broke late on June 1st and were digested by the market today.
The contrast here is just staggering. Let's start with Alphabet. They proposed a colossal $80 billion equity capital raise. Now, $10 billion of that is a private placement backed by Warren Buffett's Berkshire Hathaway.
Having Berkshire Hathaway backstop a chunk of it is, it's phenomenal for sentiment. It's the ultimate value investor, essentially validating an AI infrastructure.
Oh, absolutely.
But we have to look at the mechanics of the remaining $70 billion. Because when a company issues that much new stock, they are creating shares out of thin air to sell to the public. If you own a slice of the Alphabet pie, your slice just got mechanically smaller.
Yeah.
We call this the mechanical dilution from equity raises. It is a massive capital absorption event. Alphabet needs an unbelievable amount of money to fund their servers and data center power needs.
And then on the exact opposite end of the spectrum, you have the company selling them the servers.
Nvidia. Here's where it gets really interesting. Jensen Huang came out and committed to returning at least half of the company's free cash flow to shareholders this year and beyond.
This is the irony of the current market. You have Alphabet, historically one of the most profitable cash printing machines on Earth, having to dilute its shareholders with an $80 billion equity raise just to keep up. And simultaneously, Nvidia is transitioning from a speculative hypergrowth story into a massive shareholder yield engine. They are taking all that cash Alphabet is raising and handing it back to their own shareholders.
I think this really highlights a concept we've discussed before, tech mega capex masking broader fragility. When a titan like Alphabet has to tap the equity markets for $80 billion, you realize just how capital-intensive and potentially fragile the broader tech ecosystem is if this AI build-out doesn't monetize quickly.
It is a massive risk. Now, before we wrap up the corporate events, there was one piece of news from the White House late yesterday that provided some relief to the old economy stocks, completely away from the AI frenzy.
Yes, the White House announced a targeted reduction in tariffs on imported agricultural and industrial machinery, things like combines, bulldozers, and heavy forklifts. They dropped the tariff from 25% down to 15%.
Which is incredibly significant for the industrial sector.
Right.
Remember that 82.1 prices paid print we discussed earlier? Heavy machinery manufacturers are getting crushed by stagflationary input costs. This tariff cut provides direct deflationary margin relief.
It's a targeted relief valve, and you saw the industrials ETF, the XLI, catch a solid bid today on the back of it. Well, folks, there goes the closing bell, and what a session it's been. The Fed tried to scare us with sticky inflation and a sizzling JOLTS report, but apparently the market couldn't hear them over the sound of Nvidia backing up the free cash flow truck.
Right.
It seems the only thing flying higher than SpaceX's new $1.75 trillion IPO valuation is our absolute refusal to let macroeconomic headwinds ruin a good tech rally. So go out and celebrate your AI gains tonight. Just maybe don't spend them all on gas, at least until they figure out what's actually happening in the Strait of Hormuz.
Well said, Daniel. So for those of you planning your strategies for tomorrow, Wednesday, June 3, here is what you need to watch next. At 8:15 a.m. Eastern Time, we get the ADP National Employment Report.
Okay.
At 10 a.m. Eastern Time, the ISM non-manufacturing PMI drops. At 10:30 a.m. Eastern Time, keep a very close eye on the EIA Weekly Petroleum Status Report. Given the volatility around the Strait of Hormuz, inventory data will be heavily scrutinized. At 2 p.m. Eastern Time, the Fed Beige Book is released, which will give us anecdotal insights into economic conditions across different Federal Reserve districts. And finally, the Treasury is holding its 17-week Treasury bill.
That brings us to our bonus session, paper trading. Just a quick refresher for our listeners. We started this public experiment on April 17, 2026, with a hypothetical $10,000 to see if these daily news summaries actually generate alpha, meaning can we beat the market baseline. As of today's close, the portfolio sits at $11,334.04. That is a 13.34% return, which is comfortably outperforming the S&P 500's 6.79% over the exact same period.
That's a solid lead.
It's been a fantastic run, but capital preservation is just as important as a growth here. So, looking at the news we just digested, here are my trade decisions to be executed at tomorrow's close. I'm looking directly at that Alphabet news. I am choosing to sell 10% of our portfolio's communication services ETF, ticker XLC. That comes out to a $11,133 sell.
And what's your core justification for pulling out of XLC?
It comes down to that severe mechanical dilution overhang from Alphabet's $80 billion equity raise. XLC is heavily weighted with Alphabet stock. Even with Warren Buffett involved, $80 billion is a massive supply of new stock hitting the market. I want to proactively reduce our exposure to that specific sector before the market fully digests the dilution impact.
Makes sense.
I'm taking those proceeds and buying 10% in the technology ETF, ticker XLK. I want to rotate that capital directly into the AI CapEx arms race. Nvidia's massive free cash flow return policy, combined with Microsoft deploying all those Blackwell chips, makes XLK the structural place to be. What about you, Mary?
Well, I agree with the core thesis of reducing exposure to that Alphabet dilution, but I'm going to tweak the capital allocation slightly from my side of the portfolio. I am trimming our XLC position, proposing a 9.7% sell, which is $1,100. And I completely support rotating into XLK to capture the AI momentum, so I am adding 5.3% or $600 to that position.
Okay, so you have another $500 to allocate. Where is it going?
I am uniquely deciding to add 4.4%, which is that remaining $500, to the Industrials ETF, ticker XLI.
Ah, you're playing the tariff relief from the White House.
Precisely. I want to capitalize on that margin relief from the 15% tariff reduction on heavy machinery. In a high-inflation, high-cost environment, targeted margin relief from the government is a massive fundamental tailwind. And as for our energy position, ticker XLE, I'm holding it completely steady. We are going to watch this geopolitical brinkmanship in the Strait of Hormuz play out from the sidelines without adding to our binary risk.
That makes a lot of sense. So combining our views, here are the final aggregated decisions to be executed at the next close on June 3. We will sell XLC in the amount of $1,116.50, which is 9.9% of the portfolio. We will buy XLI for $250, representing 2.2%, and we will buy XLK for $866.50, which is 7.6%.
And as always, a mandatory disclaimer. This is a live paper trading experiment for educational purposes. It is not financial advice, and past performance does not guarantee future returns. Please do not blindly copy these trades. This experiment is a learning tool and could experience drawdowns at any time.
As we wrap up today, I want to leave you with a thought to mull over. If companies like Alphabet are diluting their shareholders to the tune of $80 billion just to lay the physical train tracks for AI, what happens to the broader market if those autonomous software agents take 2 or 3 years longer to actually generate a profit? Who ends up holding the bag? We'd love to hear how you are trading this AI euphoria versus the sticky inflation narrative, so please share your thoughts and strategies with us in the comments.